me a god. You call me a god. You call me a god. You call me a god.
Let's go. I'm about to go off like a weapon. Fuel to the top, got a filled up engine. In my thoughts, obsession. I will not stop, no, I'm never second guessing. I got a God complex. Haters love to hate, but I never feel pressed. Got a lot on my plate, but I never get stressed. I'll take all the pressure like I'm acing this test. Tear it up like I'm Jason. I see the world like it's ready for the taking. I see this place like a game I'm playing. Straight to the bank to collect my payments. No negotiations, it's my way, I was born impatient. And like a damn Freemason, I'll run this nation.
You call me a god. You call me a god. You call me a god. You call me a god.
I don't know how to stop. I just go till I drop. Whether it's working or shots, give it all that I got. You can watch me work in my element. Anyone in the way is irrelevant. You wanna cross me, cool, not intelligent. Cause I don't forget shit like an elephant. Go ahead and tempt me, put it on the line and you'll come up empty. If I got time, I'm deadly. Never caught off guard, no, I'm always ready. I got a hand real steady. Look me in the eye and you'll see no hezzy. About to get real messy. I'll put you in a grid 6 feet like Kenny.
You call me a god. You call me a god. You call me a god.
What is good, everybody? It's your boy Reckless Ray Dinero, and we are back at it again with another episode of Future Financial Strategies. Shout outs to the circa 84 family. If you're ready to take your investment game to the next level, come tap in with us in circa 84. There is a link down below in the description. If you want to tap in, ask personal questions. I'm normally lounging around in the cryptocurrency section. That is my area of expertise. That is my lane. But there are people with many other areas of expertise and insight and game to give within that Discord. In my personal financial journey, I have made a lot of headway by being in back channels, both paid and unpaid, mostly paid. And then, I've got one unpaid, couple that I pay to be in, but it's always good to be where the game is at. It has helped me personally, and most likely I think will help most people, at least steering them in the proper direction when they're starting out. Happy Thursday. Hope we're having a good week. Hope you guys are ready. Hope you guys are ready to tap in. We're going to be doing an episode of Guns and Butter this evening. Definitely tap in for that. I'm going to get better about promoting all of my stuff. I've just got to get better about promoting my stuff. I got to get better about self-promotion. If it's your first time here, I hope you take the time, listen to the content. If you enjoy it, feel free to join the Wolf Pack. You do that by hitting the subscribe button. It's down over in this corner. This is inverted. It's in one of these corners down below. Hit that subscribe. Definitely want to turn the bell notification on. I'm not a content creator who drops a lot of stuff all day, constantly, every day. We touch on 3 shows a week. There's 3 uploads. Every once in a while, we'll have a spurt where we get some shorter form content of the longer form shows. We will also be getting some shorts and reels as we expand out, but generally you only hear from me about 3 times a week. Maybe every once in a while we'll have a community post when big things are going on in the markets. Outside of that, I'm not trying to bug you. I'm not trying to constantly be buzzing in your ear. I upload my content fairly regularly. The Guns and Butter live stream is the only irregularity, and that is based on business requirements of me, because obviously I don't live here on YouTube. I own stuff. So got to handle business in the real world. This is something I enjoy to do, documenting the journey. But that aside, that's pretty much my only inconsistency. The crypto portfolio updates, which is my other show, and the future financial strategy, which is all condensed into this channel. You don't have to go anywhere else yet. And Guns and Butter, all condensed into this channel, are all regularly uploaded. And I think what we'll start doing is, if I know that I'm not going to be able to make a show, I might just throw on a restream of a previous show. Could do that. Oh, we'll see about that. But we're talking about what we're going to jump into today. We're going to have some heartfelt conversations. We are going through some tumultuous times. The markets are getting wild. There's talk of a potential continued recession. We're going to touch on that in the news. And then I have made some moves in my traditional TradFi portfolio. And we're going to start gleaning some insight into that. And we're going to start actually breaking down and talking about that. Because obviously, crypto's my lane. My portfolios have always, I'm not going to say always, my portfolios that I've tracked have always performed at minimum decently, in the sense that, like, during the time, because like I'm an avid dumper of those things because I like moving money around. And the traditional finance space, I was getting my feet under me. I was almost in a position where I was willing to talk about that. And then I got into crypto, and then I dumped all of it and then just went full headlong into crypto. But so most of my money goes into crypto. But during the bull runs, generally there's a fever pitch where the only funds that I have going on crypto are the funds that I'm generating within the space, which is going to allot me time, especially with the budget that I have now, to start allocating resources over into other avenues within my portfolio. So I've been making some moves. Obviously, with the Bitcoin ETF, we had to show a little bit of support. We picked up some of the Bitcoin ETF, but after a little bit of thought and forethought and a look at how I want my portfolio set up, I went and did some more research, found some more options, and we had to make some moves. So we did some pivots. But first, let's jump into the news. We're going to do this while I'm talking because we got a screen to share here. I'm going to bring this up on the screen. Now, these are going to just be some little quick hits here. Obviously, we'll give you the title there. It's talking about the employment rate rising rings alarm bells over the U.S. economy. And that's probably has a little bit of something to do with what the Fed did when they wanted to kick up interest rates, because the Fed themselves said that they needed about 3 million of you to not have jobs. Well, it's starting to look like more than 3 million of you aren't going to have jobs. Crazy, right? Not only that, we're raising the minimum wage, in which case businesses are now pivoting. You had all the people who got laid off, all the delivery drivers in California got a raise, and then all of them lost their jobs. Most of them lost their jobs. So between inflation, increased job wages, obviously, and it's not to say that we shouldn't increase job wages. It's a hypothetical. I mean, I think some people need their job wages increased, but that comes at a cost. So now you've got two things going on across the nation. Prices are expensive for everything. I mean, you can't even go in and get a jerky stick, a drink, and a candy, like some sort of sweets for dessert at Quick Trip or your local gas station for less than $10. Everything's just more expensive, which is fine for some of us, not as fine for others. But the prices are being driven up. Along with that, people have to question, am I going to keep these employees that want to continually increase their wages? Some of them have to be kept, depending on the level of the job, but that drives wages up across the board. But everybody says it, and this is one of the things that I've been thinking about. Everybody says it drives wages up across the board. And in theory, that would be true. But the reality of the situation is there's going to be less of the fry cook that gets $20 an hour. Matter of fact, they're phasing them out. They're getting ready. They're working on some of these places, these uber corporate, non-experiential places such as Buffalo Wild Wings, are currently working on phasing out their wait staff and their bartenders. Almost like there's going to be a bare minimum need for people there because they're trying to make it so that you're not even interacting with them to begin with. And if you're not interacting with them, then really all you need is somebody to put the drink on a robot that goes to the table. And earlier this week, a buddy of mine sent me a reel that they have a bar where they don't even put the drink on a robot. They put it on a drone, and the drone brings you the drink to your table. The drone brings you brings you the food to your table. And the drone can carry I think it was 4.5 pounds at a time. And you can put your empty drink on the drone after you take your new drink off the drone, and the drone just leaves. So now you don't even have cocktail waitresses. You have no one who brings you stuff. So all those jobs are now gone that are supposed to be $20. So when it comes to like the more skilled jobs that are already at those rates where they're like, oh, well, those people are going to quit and they're just going to go become the fry cook or work at a fast food restaurant. Those jobs aren't going to exist because those people just aren't going to have jobs. Like if you're at the bottom of this pyramid, you don't have a job. You have no way of producing income. Which brings us to the useless eater conversation. I mean, that's going to kind of be a thing. Like I have a skill. I'm not worried about my job going away because there's not robots and stuff replacing me. But I'm also not going to go look for a lower tier job at this point because those jobs are gonna be phased out. There's going to be one or two people at the restaurant doing the $25 an hour job. That's easy. And they're never going to quit until they get phased out if they know what's good for them, or they're going to skip a couple of rungs and get their education or whatever it is that they're doing on their trajectory, and it will become a transition job, in which case you are waiting for the opportunity to get that job. But you're not just going to be able to up and quit, and there's a mass exodus from skilled labor or other jobs that are slightly harder that were originally paying that $25 an hour, because the people who are newly getting minted into the $25 an hour range are going to be losing their jobs. And those jobs aren't going to come back. They're not going to be able to go to another restaurant and get $25 an hour to drop the fries because they're getting rid of all of them. And there's just going to be those 2-3 guys that need to be there, and they're not going to give those jobs up because they're easy. They're easy jobs until they get phased out. They'll get laid off and finally replaced until when they can get just the robots in there. But like those jobs are just going to go away. Like they're going to go away. The person at Chipotle, they're going to have perfect burrito bowls every day. There's going to be a robot arm that does it. People behind the line are gone. Starbucks will probably be a robot that dispenses your coffee. People behind that bar are gone. Your barista's gone. Everyone's gone. I mean, you got these people out here that are just such advocates of the traditional finance market and telling you need a financial advisor. AI can do that job better than your financial advisor because your financial advisor has emotions and they have opinions and they have biases. Those jobs too are going to be gone. Copywriters already gone. That's already dwindling. People are using ChatGPT for that. A lot of these jobs, a lot of these things that we've been holding back innovation on are going to be innovated so that those people who are demanding more wages because they believe that being a fry cook is a career, they're going to be gone because that's just the natural trajectory of things, because those jobs are at the bottom. And once you get to a point where you can clip it, if they're getting rid of copywriters and people went to college to go do that, they're definitely going to get rid of the fry cook that wants $25 because you really don't need, there's not a skill. You drop it in there, it has a timer, you take it out. Like there's not a skill ascribed to that, but people are refusing to acknowledge where this is going. And the people who are advocating for these improvements, and I understand why. I do understand the why, because you should get as much as you can get. Like you get what you can negotiate. I agree with that. But the reality of the situation is, as these people are getting what they want, they're advocating themselves out of a job, period. So like now you went from I don't make enough money and I can't live like this to I make no money and how am I going to exist, period. And it's cold outside. Something to think of. But people are worried about the economy because now the effects of them raising the interest rate and spiking it up as fast as they did, obviously incrementally, if they really could have just shocked the system and just went ahead and said we're raising it 5%. That's what I think they should have done, as opposed to stair stepping this up. But now the cheap money has dried up for most of you that were relying on it. It should be cheap money should be a kicker to your investment plan, not your growth plan or whatever you're doing, but it shouldn't be a requirement. The people who it was a requirement for are getting washed out left and right. But now we're starting to see these people lose their jobs, which was what they wanted to begin with. Because if you don't have a job, you can't spend money, thus curbing inflation. Like people stop spending money. We can bring them inflation rates down because there's no demand for the product. So then they don't need to make as much product. Product supply lines can catch up. I mean, it really depends on what income bracket you're in, because in my business, these people are not slowing down buying anything. These houses are still going up. These systems are still $100,000+ easy, and they still paying for it. So the one shift that I do see on the high end is people are shifting into things that they want, which is it's an interesting shift. I like it. They're going in. It's not necessarily 100% everything. They're putting the money where they value it, which I can respect that. Like, I like that. That's the way I spend my money. I feel like it's smarter. At least then you're not trying to impress the people across the street. You're actually purchasing things that you use. Smart move. Even if you're wealthy, like when that money starts drying up, like everybody's shoring up. So, which was what I said people were getting ready to do. But the rise of the unemployment rates in nearly a third of the countries, and at least a third of the country last month, should raise concerns over the U.S. economy. Yeah, it's going to come to a screeching halt. They're getting ready to turn the cheap money back on. And those of us who have survived the battle of attrition, me personally, I've still had access to a little bit of cheap money. We talked about the play that we did with the Discover card to front load our savings and get our stuff sorted for the primary property and getting ready to start looking and shopping for the second property. We still, and we're paying on that actively. Got a few more months, it's getting chunked down, but there's a little bit of cheap money for some of us. But like for businesses, they close those coffers. Like they're taxing you, they're charging a lot. It's getting expensive. And now that the effects of that decision, because it wasn't an immediate thing, they raised the interest rates, everybody kept spending money. They kept raising the interest rates, everybody kept spending money. Now we're starting to see these people losing their jobs, which means less people are spending money. But since it's a lagging effect, they kept raising the interest rates, and like the wave of the money drying up hadn't actually hit yet. Then it hit. And then while it was beginning to hit, they were like, oh, this isn't fast enough because it's a lagging effect. It's almost like if you got punched, but you didn't feel it immediately. And then like you got home and it hurt real bad. It's like that. Like if you could imagine that, like you get punched and you're like, oh no, I'll feel fine. And like you still out there fighting, and then you get punched and then you're like, oh, I feel fine. And then you get home and like there's nothing wrong with you. And then all of a sudden all the bruises and all the pain showed up at the same time way later. And you're like, I can't move. That's what's happened to the economy. So now we're receiving that blow. Now we're seeing it. People are losing their jobs. People are in a bad space. I mean, people had been in a bad space, which was also kind of part of the play there. Like, I don't think any of this was done by accident, but Now they're seeing the results, and now they're going to go, oh, we got to turn the money back on. And when they do, hopefully those who have survived the battle, have made the pivots, have learned how to navigate in a scarce environment, you'll utilize the money better because it's getting ready to come back. I'm ready. Yes, sirree. I am ready. And yeah, so that's what we've got for that. So first thing we're going to do is we're going to look at the ETF that I bought into. Now, before we transition over to that, let me get back up in here with you. Now, as we stated, like I've got a little bit of a portfolio. I've got a few $1,000s in there. Nothing major. I am not a trader. I'm not trapper level trapper like them dudes is trading. I just invest, and I opted to go full crypto. Put in my 10,000 hours. I've been doing it for over a decade now, and that's where the bulk of my money is. But now that we're at a position to where it's like you got 85% of it in your lane, it's time to start pivoting some of that over. And so I started reinvigorating my traditional finance portfolio. The other partial reason for that was I'm looking to establish a private banking relationship with Citibank, which is weird because none of the gurus are talking about private banking relationships. And it's like, well, if you got money, why would you? Like, I guess they're out there doing everything with just cash because they're super rich on YouTube. And they don't utilize private banking relationships. Me personally, over here in Future Finance, over here in the Wolfpack, we utilize all the tools, and private banking is a tool that the majority of wealthy people use. We're just gonna throw that out there. Majority of wealthy people are in private banking relationships, and in order to get that, you just got to have a lot of money at the bank. So we were looking at Citibank, we're looking at some of these thresholds and the type of account that I have. And so my goal is to hit that initial metric of when they start taking you seriously, which for Citibank, I think it's like $30,000 or $40,000 in assets held. And I wasn't about to just have $30,000 or $40,000 sitting in the bank. That's like not even a worthy goal for me. Like I would not do that. But I was able to they have a brokerage account that is also cumulatively looked at with that, because I don't like keeping money in the bank. I think it's stupid personally. It's dead assets, and I never have an emergency that I utilize like that. Now, what we did do, which is kind of fun for gamifying getting the savings account in there, is we have our cash reserve, which we're using in the same fashion that you would if, for instance, you were working with in-home banking. Now, obviously, the growth potential isn't there really, except that when I use the money and you pay it back with a little bit of interest, just like with the in-home banking model, I do flat 10% because it's easy math. But that 10% just adds to the money pool. So every time I borrow that money, the pool gets bigger. So I'm incentivized, just like if I was using my credit card. I take the money out of there, but it's a bank account that regularly gets drained and then incrementally refilled. And so normally what I'll do is I'll split it up over a few paychecks, and it's like I'll normally just take a set amount to where so right now with the amount that's in there, because it's under $1,000, it's just 4 payments. I split up into 4 payments. I'm like, I'll pay this back later. I can buy something semi-big. Normally it's something that I need. Usually it's something like the last time that I just used it, I had to replace my computer at work because I broke the other one. And, I've had that computer for a few years. It was old. I wanted to get something I could put Windows 11 on at some point. And I wanted something faster that works smoother with solid state drive. So I got a Surface Book 2. Didn't even get the newest of the newest Surface Book. I got a Surface Book 2. I don't need to be flashing. I ain't trying to ball on nobody. It's a work computer. Use it at work, doing programming. Also, a little bit of crypto stuff on there. It's my new workhorse for that as well. But the main point there is when I pay that back, the 10% off that total amount goes into the pool. So now the next time I pull out of it, which after we do that, I think I'm going to experiment with the new off camera. I like the phone, and we're going to see if we keep it, but I'm also looking at getting a GoPro so I can have some more work functional stuff that I can also do and, get training footage and stuff like that. It'll actually expand my channels because I'm also going to start uploading for some of the projects that I'm doing in the industry that I've been in, because I've also worked in home automation for 10 years, and I figure I can actually talk to it. And some of my stuff, like the fabrication projects, I like to document some of that just to, show that I'm multifaceted. I got skills. So I think the next large purchase after I get this work computer paid off will be that. But I use it in that fashion. That grows that pool of money. Now, I'm fine with it growing that way because it's being utilized, and, like, I'm paying myself back. It's a big financial discipline thing. Most people will not utilize their money like that, but that was the only way that I was going to put money in a savings account there. So I do have that growing. The other thing that I've got going, and honestly, I think after this year, I think this first year to experiment and like mess with it, I'm going to do it that way. But I think what's going to happen, I mean, it might happen about 6 months through this year, because I've been doing that for a little bit, but because I've been doing it for over a year. But I think what will eventually happen is I'll start splitting that 10% that I pay myself back 50-50 and start putting some of that into my brokerage account to grow that as well. Because after we get it up over a certain point, like, I just don't see the point in it. I just don't like having cash in the bank like that. And like, I guess my goal is to grow that up to the point of a high deductible payout, basically, for my insurance, which would be about $5,000. And because one of the hacks that I do at work, do the high deductible, and then I put away in the HSA because you get an additional tax write-off for that. But which actually, funny thing, I gotta call my HR department, because this year actually is the year that I can start putting in the market and messing with that. So I got to see how that works and what I need to set up to do that, and see if I can self-manage it so we can get them onions, and then we can mess with keeping the principal and, like, getting a thing or two here off the dividends. But that aside, I don't like keeping money in the bank. That's the moral of the story. But I don't mind if it's gamified in that sense, where I'm using it as an in-home banking deal, and I can build the money that way, because that doesn't affect me, because like then it's doing something. Like, the money's not just sitting in the bank, because the bank interest, like getting that 2%, like, nah, bro, like that's not the play. And also, I'd rather pay myself than my credit card, because like after a certain point, I'll probably just start paying all my bills and stuff with cash, because it will be pointless for me to do them with the credit card. I guess, you know what? That might be a good game too, is to get that first nugget of it, have all my stuff in cash, and then I would really be pulling off of my credit cards, which you got to look at the point system, but like even converting it over and paying everything on the card, but paying it immediately, and then just refilling that account could be a thing too, because I want that money working. But right now it is, because consistently I have something that I can utilize that for. So, and then when I don't have it for that, I use it to supercharge my savings rates. And I just use it as though I was taking a loan, just like what we did with the Discover card, except for it's from myself. And then I pay that back. Like, there are options. And I mean, at this point, obviously we're working with our debt float. even chunking down the debt float could also be a good play for that. So yeah, there's always something to do with that money. So I ain't worried about it. I got a lot of financial games I can play with that savings money. But with my traditional finance portfolio, I did want to put some Bitcoin exposure in there because I got some stuff that I'm looking at for the bull run. There's not a lot of money flowing into it right now. And honestly, there probably won't be. And like, there won't be until about midway into this year. Like, we're looking at post-halving. It's going to be like April. Yeah, April, May, June, maybe, depending on what the post-halving we do and how fast the numbers go up. But we're looking at shifting over. So there's going to be some money flowing into the portfolio. So we're going to be building it out. And I'm planning on, once we start building it out, most of the time, once the bull run starts, we don't actually drop back down into any type of buy range where I would want to put my money into it for a while, which is fine with me. But this year, like I said, we're keeping our focus laser sharp. We're implementing all of the strategies. We're going to be on top of our finances. So as I'm looking through, I was like, I want some Bitcoin exposure. We got the Bitcoin ETFs. I wanted to show my support for it. It's a nod to my industry. It legitimizes my industry. It makes it so that, you know, the Wall Street trappers and the pocket watching with JTs can't necessarily be 210% disparaging to the industry, considering that now they're going to be recommending it, because it's in Trapper's Lane, and JT is a financial advisor. Now they're going to be pushing because most likely they get kickbacks. I don't know how his business model's set up, but I know that there's a lot of them where they get incentives for recommending you stuff that is subpar performance. So now they can recommend something that's printed over 100% gain. And I understand the market's down right now. I got you. We're going to talk about that too. Over 100% per year on across the average from its inception to now. And now they can recommend it to be in your portfolio. And I wanted exposure in my portfolio. Now the reality that set in on me though is I am a Bitcoin holder. Like, I have Bitcoin. So I don't need a middleman between me and my Bitcoin is basically the gist of it. And we had that talk on the pros and cons. And after I had to go break down the cons, I actually started thinking about it. And I was like, I would honestly rather have the companies. Like, I'd rather have Coinbase, which is coin, or some of the mining companies, which are getting ready to hit a discount because the market's down. And some of those mining companies, like the main one, which I forgot the name of it off the top of my head, but is down like 50% right now because the market dropped. And like, they don't know how to value these things. They don't see what's coming. So that's at a steep discount. I was like, man, I could sell it. I could jump into that. I'm looking at plays. And I ran across. So what we're going to do is we're going to talk about the one that I currently have. Let's break this down first. So hold up a second. I'll pull this back up. So which one did I get? I got the BETH. And this is a good breakdown for those of you who are not familiar. This is from iShares. This is from ProShares. This is was a solid one. And the question is, it's like their little spiel on it was literally the reason, like, it was very well thought out. This was a very well put together ETF, in my opinion. You captured the potential of the two largest cryptocurrencies, Bitcoin and Ethereum. It's a Bitcoin and Ether market cap weight strategy. Targets the market cap weight performance of Bitcoin and Ether in a single investment. Why? Familiarity, liquidity, and transparency of an ETF. Now, liquidity, Bitcoin and Ethereum, very easy to move those coins at all times a day, 24 hours a day, whenever you need to get in. The liquidity pools are very deep. They have all the trading pairs. Super easy to move. And obviously, why were these ETFs even made to begin with? They're available in a brokerage account. So now you don't need to open up a Coinbase. You don't need to open up a Gemini. You don't need to open up a Kraken. It's for the lazy people. The concern, well, actually, it's not even a concern. The problems with it are there is a middleman involved. The problems with it are you don't actually own Bitcoin or Ethereum. It pays out in US dollars. Those are the problems. So for me, I own Bitcoin. I am currently on the way to accumulating. Our goal this year, for those of you who've been following us over on Crypto Portfolio Updates, is to navigate the cryptocurrency market and work our way up towards our goal of 32 Ethereum to go into the retirement ledger with my Bitcoin. Those are the goals. Now, this was awesome, and it is one of the ones that I like. This was my favorite one. That's the reason I purchased it. I just started buying it. I bought it day one. Obviously, we sold at a little bit of a loss. I bought it in my Roth, and that's what it is. So like I thought about it, and I was like, since I hold the actual assets, there's no reason for me to have an ETF of this nature in, hold up a second. Not the fund, expense ratio, market cap, distributions. Now discount. Expense assumption day. Interesting. So, and I think this one also pays a dividend potentially. We'll see. I wouldn't be surprised if it didn't, since they're holding Ethereum. Very easy to generate income holding Ethereum, especially if you have a bunch of it. But what I was going to say, let's get to the nitty gritty, was this is not a good fit for my personal portfolio because I do hold those assets and I am very much into the cryptocurrency space. So this didn't make sense for my portfolios. Let's jump over to what does make sense for my portfolio and where I'm at. Now, those of you who know, let me pull this down before we jump over there. Those of you who have, sorry, dropped myself instead of the deal. Those of you who have listened, those of you who've been tapped in, those of you who've been dialed in for any amount of time, understand that from a traditional finance perspective, the only thing that I'm looking at now, I have this as my traditional finance portfolio is very close, near and dear to the Stay Rich Forever portfolio. And what we are doing is we are looking to build a portfolio that generates income via dividends that are either that will, I mean, obviously in the onset will be used as supplemental income, but eventually like you retire and then you have your supplemental income from that. I'll be fine with that. And for me personally, supplemental income of 60 grand a year, I'd be fine with that too. For not having to do anything, because it's not like I'm not going to do anything, but like if you've got a base level of 60 grand a year, then I can do whatever I want from wherever I want. Because I mean, technically speaking, at that point, if you got $60,000 a year coming in passive, where you're just managing a portfolio, and you didn't live in America, you're extremely rich a bunch of other places. So that could be an option. But supplementally at 60 grand a year, I'm like, I can not work hard. I cannot work grueling. Like I can go do some other stuff. I can go take projects elsewhere. I can go do a bunch of other things. Like it'll leave options open. And then if I want to keep grinding it out and continue to work super hard in a manual sense, like I'm looking at it as at that point, I will officially be able to start focusing on thought work or focusing on growth from a financial perspective. Now I'm looking at money plays only. Like, I'm not necessarily going, oh, am I going to go put in 70 hours doing manual labor this week? No, probably not. So as we're building towards that, we're looking at we're doing that. I've got real estate, and I've got crypto. Those are my 3 bags. But for the traditional finance piece of it, I'm more interested in dividends specifically right now, especially as a budding portfolio. Like, I'm exclusively looking at dividend things. Like, I'm like, if I can stack these dividends and get $100 a month and then keep stacking that, like, that's my goal right now, is to get both of my portfolios producing $100 a month. And then with that $100 a month, if I want to start buying some long-term holdings, I can do that as well. But I would rather have everything going towards getting that dividend up and getting to that $100 a month. I feel like that would be a catalyst for me, because then when those dividends come in, you're reinvesting. You're growing that, and now it kind of, that's when the snowball gets interesting, in my opinion, because at $100 a year or $100 a month of sheer dividends, you can make plays. Like, you could buy, technically at a certain point, you can start buying some stock. Like, you can get some companies at that point. Like, you could do some other stuff. Or you just keep reinvesting in those dividend stocks and disperse them accordingly, and you just keep growing that deal. So that's where we're at currently. We're currently, I think, in the one portfolio, in my traditional finance portfolio, which is the one that needs to be higher, we're at it's like $16 a month. So we got a little bit more work to do on that one. Over in the Roth, that one's producing $35 a month. That's actually pretty impressive, but that's because that's where I started. I converted stuff over there first, but I'm okay with it. So so let's jump into what we added. So I got rid of the BETH, and this is what made sense to me. I went ahead and switched this over to an ETF called YBTC. Say that one more time. YBTC. And what that is, it's the Roundhill Bitcoin Covered Call Strategy ETF, YBTC. It is the first listed Bitcoin covered call ETF. The fund offers exposure to Bitcoin subject to a cap while providing the potential for high current income. YBTC is an actively managed ETF. The income potential. YBTC seeks to generate monthly income through a covered call strategy on Bitcoin, which has historically offered significant option premium. You also get exposure to Bitcoin, obviously subject to a monthly cap. Actively managed, YBTC implements a covered call strategy, saving investors the time and expense of trading options themselves. I like it. So you get to, so for me, this makes sense. Like, I would prefer this, because if it's generating monthly income, I understand that you're not going to have the growth of holding individual stocks, but with a portfolio that we're focused solely on income, which is my predominant focus, after we get some income generated and we start getting to the numbers that I'm wanting well down the road. Actually, I'm not going to even say well down the road, because like, I am heavily investing in all my stuff. So we'll probably be pulling a little bit. Well, we're actually going to be pulling for the next property, but we'll be shifting the income focus and the cheap money focus and the investment opportunities to bulking out my portfolios this year as well, moving into the bull run, which will give us a year, year and a half, something like that, 2 years maybe, of really laser focused on my portfolio. So as we're building this income stream out, adding this into the portfolio gives me the Bitcoin exposure and the income. So the way that I'm looking at it for what I'm trying to do with my portfolios is create that income. So like the Roth obviously will be the post-tax, you're in the retirement failure fund income, and the active traditional finance portfolio that I've got over at Citibank that I can just get at whenever I want. That income is, we're looking at covering all of our daily expenses currently. So I would like to, my metric that I'm going with is as it sits right now, my exact expenses right now is my minimum. And we're looking at having that cover the minimum. Not necessarily that we're trying to touch it, but we're looking at building that portfolio out till it's covering a minimum standard of lifestyle that we're doing the snapshot of. And I'm like, I don't complain about my life right now. Find it rather enjoyable. So I'd say this is a decent minimum while I've still got my head down, nose to the gridiron. I'm like, yeah, this is sustainable. I could do this day in, day out. I'd be fine. Like if I could just chill, have a little bit of fun that I'm having right now, this being a minimum for me is a good minimum. This is a minimum where I'm like, cool, I could be content with this. Like I could be content right now. Like if my brain wasn't wired the way that it was, I'd be more than happy with exactly how things are right now. Like I'd be good. Like if I wanted to just be normal, like this ain't bad for a normal person. So this is the minimum. This is what our target is. As we're building out the portfolios, though, especially the traditional finance side of things, for which will be covered heavily over here on Future Financial Strategies, it's important to always be looking for things that are in alignment for the way that you're trying to build out your portfolio. Now, as the months roll on, I still have BETH on my watch list. And so we'll see if they start paying out a dividend, because we could bring a position in that back later on. But I'm like, I would rather have the fund that I know is solely looking at generating monthly income for me, take that position and have the predominant Bitcoin exposure in my portfolio be that, because it aligns with what's already there, with what we're already building out. And that's the way we're looking at it. But that's why I dumped my BETH position from ProShares and why I replaced it with the YBTC position from Roundhill. Roundhill made a product that is directly in alignment with what I'm looking at, and also calls catch things on the upside when stuff's going up. I think that this is going to overperform during the bull run, which is coming. We've already started, but it is coming. And I understand that people are going to be like, oh, well, like the pullback, and this happens every year. It happens every bull run. Every bull run that I've been a part of, this has happened. And what they're doing is they are shaking out the people that are trying to come into the market that don't have a long-term perspective, that aren't dollar cost averaging, that aped in at 45,000 because they saw the price shoot up. And now that the price is sitting down at 40, 39, could touch 35, they can't hang because they act like they need that money right now. So they sell the position as though it's going to zero. And meanwhile, these institutions are buying all of those Bitcoin that you're selling up. Like it's just going to them. It's going to me. Like when we get to this weekend and we do our cash outs, it's going to be a little bit less than the previous cash out at the beginning of the year, which was on the 13th. Going into the 27th, we're gonna do a separate cash out. It's gonna be a little bit less. We're gonna distribute it. We're gonna get our dollar cost average in there, and then come February 2nd, February 2nd comes payday, and we can buy again. And depending on where we're at, actually, it doesn't even depend on where we're at. We buy every payday, but that's where the bulk buy comes in. Actually, that's where the bulk buy comes in. So, we follow the dollar cost average. We're going to get a little bit extra. I actually have a little bit of the overtime pool of money left, and we might fire off that shot, see what it do. But otherwise, we're just hitting this every 2 weeks like clockwork. When payday comes in, we get our money in the market. We're saving in the market. We've got multiple avenues of where stuff is going. And we're staying the course, which is the important thing. And I think we're gonna call it on that. I hope you guys have gotten some value out of this. I hope you guys do your own research. Obviously, we're just talking about what I'm doing with my money over here. But what you do with your money should be heavily researched. You should be doing at least as much research as I am, because it's your money and you should care about it. And people who are good stewards of money generally have more money come to them. But I want to make sure that you guys are getting as much value as possible. And I hope that you guys saw value in the video. I hope you liked the video. Again, if it's your first time stopping through, definitely subscribe. Definitely hit that bell notification. And last but not least, if you're serious about your investing journey and want to dive more into the weeds, have more specific questions answered, one-on-one coaching, one-on-one conversation, strategy conversation, tap that link down below and join us over at Circa 84. It's your boy, Reckless Ray De Niro, and I am signing off till next week. If you guys want to talk live, tap in with us tonight over at Guns and Butter. Be starting around 7:30. Holla. Peace.